Hello, chart watchers, and welcome to Market Watchers Live with Erin, Swenlin, and Tom Bowley. I'm your host, Tom Bowley. Today's show is being recorded, so you should be able to play back any or all of Market Watchers Live at your leisure. If you're unable to attend the show live, you can now go to www.stockcharts.com/webinars. Follow the link to Market Watchers Live and play back the show. Each show will be archived on our site until the next show begins, so you'll have roughly 24 hours. If you'd like to review an older show, you can now find those at YouTube or on Facebook. During today's show, please feel free to submit ticker symbol requests, questions, and comments using the chat window next to the video player. Later in today's show, we'll select stock symbols from your requests and use those in the 10 in 10 segment at 12:50 Eastern Standard Time, where I'll attempt to annotate 10 stocks in 10 minutes. Market Watchers Live now airs 5 days a week, Mondays through Fridays, from noon to 1:30 p.m. Eastern Standard Time. If you want to be part of the show, you can reach us via our chat room or Twitter. Our Twitter handle is at Market Watchers Live. That's at MKT Watchers Live. As you leave today's show, we'd love to get your feedback. In the lower right portion of your screen, you'll see a How Do We Do section with a link to a very brief survey. Let us know what you think of Market Watchers Live, and feel free to provide us some suggestions for improving the show. For those of you joining us for the first time today, welcome to the show. We are certainly glad to have you. And for our regulars, welcome back. Got a couple of quick announcements to make before we get started. Today, of course, Erin is back, and she will be going through the DecisionPoint trend models. So some interesting stuff there for you to have today. Tomorrow, there's a Stock Charts Outlook show. I will actually not be able to make it, but I believe Greg Schnell and Arthur Hill will be hosting that webinar tomorrow. Starts at 11 a.m. Eastern Standard Time. And you can get there simply by following the webinar link at the top of, on the menu at the top of the page at stockcharts.com. Click on the webinars and just follow to the Outlook show for tomorrow. And next Wednesday, we're going to have Arthur Hill here on Market Watchers Live. So you're going to get a lot of Arthur Hill here over the next few days. But it's always great having Arthur as a guest on the show. And we'll get his take on what he sees as we head into the end of the year and into 2018. So that should be a great show as well. Again, that'll be next Wednesday, and that will be December 13th. Well, Erin, it is the end of another week. I know you got a busy day today, letting everybody know about the DecisionPoint and the trend models and, you know, how you go through and what those signals mean and all. But how are you doing today?
I'm doing quite well. It was a nice day off yesterday. Everybody's asking about the fires. I'm definitely safe. They're out toward LA, and I think they're now in San Bernardino Mountains. So at this point, I'm pretty safe because I'm in the Santa Ana Mountains. So it's not too bad. But really interesting. I was sitting on the patio, and I was like, wow, it's super cold. And I looked, and it was 41 degrees. So I think that's legitimately cold to everybody out there. But what was crazy is I was looking at the hourly, and by the end of the show, today, it's already going to be 71.
Wow.
30-degree difference. And our high today is 81. Go figure. So
I saw someone post just a couple minutes ago saying that it was snowing in Atlanta. And I'm not too far from Atlanta, just a few hours away. I'm closer to, just south of Charlotte. But I went out this morning, and it was a really cold rain, maybe around 40 degrees. And I think the temperature was supposed to be dropping throughout the day.
Mm-hmm.
So we're getting our first really cold blast from the north. So I just want to thank all of our friends to the north for sending this down here. Little sarcasm. You can have it back. I'm not a cold weather fan. It's hard to play golf in this. But anyway, weather is something that changes often, just like the market. And we got a lot of stuff to go over today. I know you've got your segment to get into, so I'm going to let you go through the agenda and that first market update, and let's get this thing rolling.
Yep. So market updates on the hour. So we'll have one as soon as we finish with the agenda, and then one at 1 o'clock after the 10 and 10. We have some technical news that Tom will go over for you while I prepare for the DecisionPoint trend models discussion. And they're quite simple. So we'll see how long it actually takes me to get through them. But I definitely encourage questions as we go through. Do our 10 and 10 to 1. And our first one will be Trinity Industries, TRN, and this came to us via Twitter just a little while ago. Sentiment update, I will be doing that as well at the end of the show. And of course, if we have time, we'll do our mailbag and wrap up. But with that, I'm going to go to our first market update. All right, and here we go. I'm going to take you to our candle glance screen here so we can get pretty much everything we need all on one page. So as you can see, markets are up today. I was looking at these 2-day charts, and I thought it was interesting. You know, the Dow is making a nice steady run to the upside. We got that gap on the S&P 500, but ultimately we're really just consolidating sideways. And then the Nasdaq got that really great gap up push in the morning at the open, and since then it's just been falling back down. So we're almost to a point where we've lost like half of the gains on the day for the NASDAQ. Russell 2000 is gaining slowly, not quite at its intraday highs. It does have to make quite a move to get up there, but starting to rise again. Wilshire 5000 still consolidating kind of sideways here at this point. Treasury yields mostly unchanged at 23.81. UUP is rising at this point on a steady move. We are seeing a little bit of a pullback, though, since 11 o'clock Eastern. Commodities, a rather volatile day. Had a nice open, fell right back down, but now we're getting ready to go back up toward those intraday highs. USO, we can see a gap up and similar, of course, look to the commodities DBC. Now looking to make new intraday highs on USO, currently reading at 1152. Gold had an okay morning, but it has spent the rest of the day moving back down. Currently, we're in the negative, but mostly unchanged since 11. And we can see volatility index is moving lower. We're now with a reading under 10 at 976. Advances and declines about the same, are even. Looking at the market summary. There we go. I will set it up by percent change so we can get a good idea. NASDAQ 100 is still doing the best at this point, up 0.6%. Utilities are in the negative. That's really the only one. All of the other major indexes are in the black or the green as they rise. We can see healthcare and energy are leading right now as far as the sector spiders. Consumer staples and utilities at the bottom, but utilities is the only ETF that is moving lower at this point. All the other spiders are moving higher. Natural gas, oil services, as far as our industry indexes are concerned, are leading. Also, retailers up there, up 1.25%. Utilities and paper semis are all in the red at this point. Everything else being on a move up. International ETFs, China ETF and Italy ETFs are leading at this point, up over 1%. And we can see the laggards would be Malaysia and Russia. However, they are all moving higher, albeit very slowly. So all of our international ETFs are currently reading up. And with that, that is our the end of that market summary. And I'm going to pass it back to you, Tom, to go over some economic news while I get my presentation ready.
All right, sounds good. Appreciate the update. Yeah, we're having a pretty good day in the market. It started off with some pretty good economic news. The monthly non-farm payrolls for November came out, 228,000. Market was only expecting 190,000. So we had a slight beat on the ADP employment report on Wednesday, but then had an even nicer beat with the non-farm payrolls today. Private payrolls, 221,000. The market was looking for 184,000. So another beat there. Unemployment rate, 4.1%, came right in at expectations. And average hourly earnings rose 0.2%, and the market was looking for 0.3%. And I always pay pretty close attention to that number because it does have a pretty strong correlation to inflation, and at least in terms of wage inflation. So average hourly earnings coming in a little bit less than expected, I think, was good news for the market. December consumer sentiment, 96.8. Market was looking for 98.8, so a little miss there. And October wholesale trade was down 0.5%. The market was looking for a much more modest number, down only 0.1%. So you put all that into the mixing bowl, and the 10-year Treasury yield is up 0.5 basis point, 2.38. So the market right now, the bond market anyway, is just kind of sitting waiting with bated breath for the Fed. I think part of it is they're waiting for the rate hike. I believe we're going to get a rate hike. That's what the Fed's been telling us that we're going to get in February, or excuse me, in December. And so I don't think that's really a big concern. I think the bigger concern is what the Fed has to say about the selling of the bonds that they had purchased and built up their balance sheet over those many months several years ago. They've talked about unloading them, so I think an update on what exactly is taking place there, I think, will have more of an impact. And of course, with the Fed selling treasuries, you're going to have others perhaps following suit. I mean, if you remember back in, when we went through all that quantitative easing and the Fed was buying these securities, of course, everyone knew they were buying securities. So I always referred to it as legalized front running. You've got all these bond funds and so forth that were buying bonds, knowing that the Fed had their back. The Fed was going to keep buying. And so there really was not a whole lot of way to lose money. Treasury prices kept going up. And of course, yields kept dropping until we hit historic lows. Now we kind of we're on the other side. And so if you got selling coming up, and there have been some comments, that the short term, when you look at the yield curve, that some of the shorter term treasuries are going up faster than the longer term. And that is true. We have been seeing that yield curve flatten, but I'm not so sure that we're not going to see higher 10-year treasury yields as a result of some of what the Fed's doing right now, what they're going to have to do in 2018. I think it could be a flip of what we saw back, I don't know, a handful of years ago when we went through all the quantitative easing. So that's something to just be thinking about as we go into the FOMC meeting next week. But I'm sure one thing's going to come out of it is we're going to probably see a 1/4 point rate hike. I think that's what has been built in. I think that's what the market's expecting. And anything that veers from that would probably grab the stock market's attention. The stock market doesn't like uncertainty. It doesn't like surprises. So, and I think the Fed over the years has gotten pretty good about, kind of dictating what they're going to do before they actually do it. They send all their presidents out from the various districts around the country, and they kind of say what they're going to be doing. Everybody has a pretty good sense of what's going to take place. So that's kind of interesting. I wanted to go into my blog only because there were a couple of comments on sectors that I thought worthwhile taking a look at. And the first being the industrials. I kind of explained the negative divergences. And if you're a fan of the MACD, or maybe if you're not that familiar with the MACD, it is interesting to see what happens in a particular index or a sector or a stock, ETF, whatever, when you start to see signs of slowing price momentum. There are plenty folks out there, many of you probably, that don't believe the MACD serves any purpose. I tend to think otherwise. MACD is a big part of my trading style and my trading strategies. But here is an example on a 60-minute chart. This is an intraday chart. We don't go over a lot of intraday charts, but they're very, very important, especially for short-term traders. And the XLI, the industrial ETF, you can see here with the higher prices back at the beginning of November, notice that the MACD, the 60-minute MACD, had turned lower. And so what happens? Well, it just because we're on a different time frame doesn't mean I change my strategy or what I expect. When I see a negative divergence, I do begin to think that there is much greater potential for, in this case, the XLI to drop down and test its rising 50-period moving average, in this case, 50 hour. And then the other thing I look for is a centerline reset, because what this is doing here, what this negative divergence is telling us, is that the 12-hour EMA and the 26-hour EMA are beginning to converge. So as long as the MACD is going up, like it was back in the latter part of November, it means that momentum is accelerating to the upside. Your short-term moving average is accelerating and diverging away from that longer-term moving average. But as prices go up the next time, that's where we see a lessening of the MACD or a convergence. So that's what the MACD is, moving average convergence divergence. So they're either diverging or they're converging. It's one or the other. And as prices move up and the MACD moves lower, that can be a pretty significant sign of slowing momentum. Now, when I'm looking at a 60-minute chart and I see it, you have to understand you're looking at a very short-term time frame. So many of these, you'll see some weakness, but it doesn't last very long. And here in this case, the negative divergence printed on December 4th. And by December 6th, we already had the 50-period test. And we already had, by the 7th, we had the MACD hitting centerline support. And of course, at the center line, it's telling you there's no distance whatsoever between the two moving averages, the 12-period and 26-period moving average. So at that point, momentum is gone. And, my reference is just, the game starts over again. Now what we're seeing is the MACD starting to move back up and showing some positive momentum. If I click on this chart, then we can show today's action, which continues to be a little bit higher, and the MACD continues to go up with it. If I go down, I want to show you one more chart. This is technology, and this is the one that we've all been watching pretty closely. You can see with a negative divergence here, higher prices, lower MACD. We got selling, but it wasn't nearly as controlled. Here, it was just like a steady move down. We hit the 50-period moving average, and boom, we were done. That was not the case with technology. And the big reason, in my opinion, is that we also had a negative divergence on the daily chart. So it required more selling. And anytime you start seeing selling in an area that just seems to go up every single day, you get some panic. And so we got a combination of that going with the XLK. And notice as we were going lower, these red arrows are marking failures at the falling 20-hour moving average. And then notice just yesterday, we moved back up above that 20-hour moving average, came down and tested it, and then actually held. So it was a successful test of that rising 20-hour. And now if we click on this and get an update, you can see that we have continued moving higher. The MACD is broken. The 60-minute MACD is broken back up into positive territory. And now we're starting to see more short-term signs of strengthening in technology, which is a good thing in the market. We don't want to see technology beaten down for too long. But while technology was out of favor, we did see money rotate nicely into the other areas. We've seen really big moves up in the financials. We've seen moves up in the industrials and in consumer discretionary. And I still am a fan of healthcare. I mean, the XLV had a pretty nice little cup here, pulled back to the moving averages, and now starting to move back up again. We do have a trend line that has continued to hold. So everything remains, in my opinion, in a bull market, and it's just the rotation that is moving things back and forth. So we'll talk about some more things going on in the market, but I'm going to turn it over to Erin. I know she's got a lot of interesting information for you with the DecisionPoint trend models. So take it away, Erin.
All right, I shall do that. Let's see. Get to where I need to. All right, if there's any problems, because seeing this, of course, please do let me know. So I'm going to get in here to play this. Sorry, I'm having a bit of problems here getting things out of the way. Here we go. All right. I think that's good. Okay, so I'm going to talk to you today about the DecisionPoint trend models. They're actually very simple. It's probably something that a lot of people do anyway without naming them. So DecisionPoint, we grabbed them and we have named them our trend models. And let me tell you a little bit. I'm going to tell you a little about DecisionPoint just so you have an idea of what the heck it is. It's a company that Carl Swenlin created back in the 1990s. It actually started as an AOL message board, believe it or not, and kind of morphed from there into a email newsletter, etc. DecisionPoint, when I say that, I also consider it a analysis process that I follow. It's the DecisionPoint analysis process. So I'm going to go over part of that today. We have the timing models, and the timing models are made up of our trend models and the PMO. So using those together, that's how we come up with timing signals. We also have those market indicators that I show you pretty much all the time when I do the DecisionPoint reports. And we used to have technical reports and spreadsheets. I apologize. I should have taken that out. But we did end up taking out our spreadsheets. We just weren't getting enough hits on that. So the decision point analysis process, of course, you want to keep it simple. The main thing I like to do is identify your market bias. And you can do that by looking at your indicators and the trend models. And here we go. You identify the trends. Are we rising, falling, or neutral? And that's what the trend models tell you. And then you can identify conditions. And that's what I use the PMO for, to find out overbought or oversold conditions. And of course, once you have all of your information, act accordingly. Follow your rules, follow your analysis process. And as I always tell everybody, don't talk yourself into an investment. There's always something out there that has a good setup. Doesn't matter, bull, bear market, doesn't matter. There's always a setup out there. It's just a matter of finding the best one and not talking yourself into one that won't turn out so well because you had to talk yourself into it. And then we do have some special studies that we do. You can find in our DecisionPoint chart packs. When I talk about timing signals, I always give you ground rules on this, because the trend model will generate these signals. You'll see them, for example, on our DP, the scoreboards. You'll see them. You'll get buy signal, sell signal, the timing signals. But if you get one, you have to look at the chart. That's why it's all in capital letters, because you've seen it. I get that PMO scan, and I've shown people how I just use the little trash can to kill it, even though it came up in the scan because the trend was right, the PMO was set up right. But then you look at the chart and there's either a terrible chart pattern, or you can see the high volume on a sell that can make you worry, etc. So you take critical thinking and you add that to your timing signals, and then that's how you're going to be more successful. If you want to look for weekly and monthly signals for the PMO, you have to wait till the charts go final. And again, don't settle. Great setups will happen. They are out there. So I'm going to tell you, focus mostly on the trend models and how I identify the trend using the trend models and their signals. First of all, there's 3 of them. The long-term trend model, and that is based on 50 and 200-day EMA crossovers. The intermediate term trend model is 20 and 50-day EMA crossovers, but in relation to the 200-day EMA. And I'll get into that a little bit more as we continue. The short-term trend model is your 5 and 20-day EMA crossovers in relation to the 50-day EMA. And again, I'll explain what I mean by in relation to, because that does change the signal. So here's just a basic chart, and I apologize, it's not quite that big. I'll be going over some real life samples that are, well, not from July. So we'll have a better look at these. So the long-term trend model is based on the 50 and 200-day EMA crossovers. So for example, the ones I have pointed out, there's a long-term trend model sell signal. You could see that 50 crossed below the 200-day EMA. There's your long-term trend model buy signal when the 50 crossed above the 200-day. Again, very simple. The intermediate term trend model, that's where it gets a little tricky. And I'm going to show you some of those a little bit more later, like I said, in some more real life examples. This chart's kind of small and messy. So you can see right here, this is an intermediate term trend model neutral signal. You only get neutrals and sell signals, of course, when you get negative 20 and 50-day EMA crossovers, okay? The trick is finding out if it's a neutral or a sell, and that's based on where the crossover occurred. Did it occur above the 200-day EMA, or did it occur below the 200-day EMA? That's important, because if it occurred above the 200-day EMA, I'm technically looking at a stock or ETF or index when the 50 is above the 200. it's in a bear market or bull market configuration. 50 is above the 200, you're in a bull market configuration. So if I get a negative crossover, but it happens above the 200-day EMA, I'm not going to get too aggressive and go into a short or a sell signal. I go to a neutral signal. And of course, everybody's like, well, what does that mean? Well, technically, in a perfect world, it's mainly you're fully hedged or in cash when it in terms of whatever that chart is you're looking at. So it's a good time to maybe close out an investment. If you're on a neutral. But I do know people from all of the years with DecisionPoint who will still be more aggressive. And anytime there's a negative 20, 50 crossover, they'll always consider it a sell or a short. So it does have to do with the way you look at it. I personally don't want to get that aggressive, especially in the intermediate term. And especially when things are in a bull market configuration. So those are the long-term and intermediate-term trend models. And like I said, I'm going to go and look at some real-life charts so that it'll be easier for you to see what's going on. All right, so again, long-term trend model, 50 and 200-day EMA crossovers, intermediate-term trend model, 20 and 50-day EMA crossovers in relation to that 200-day EMA. I didn't talk about it, but anytime you have a positive crossover of the 20 and 50, it's always a buy signal. So there's no concern about is it a neutral or a buy signal. No, it's just a buy signal. Anytime you get a positive crossover, it's a buy signal. The question is when you get those negative crossovers. And that's when you have to look at where that crossover occurred in relation to the 200-day EMA. But there is also the short-term trend model. If you understand the intermediate-term one, it's not going to be too hard to understand the short-term one. We use 5 and 20-day EMA crossovers for the short-term trend model. And those are in relation to the 50-day EMA. Again, we're looking for crossovers that occur above, negative crossovers that occur above the 50 or below. So let's look at an example here. And all I have on this chart is the 5-day, which is pink, the 20-day, which is always green on my charts, and the 50-day EMA, which is always purple. Before I continue, I also get a lot of questions. Why do you use EMAs and not the SMAs, simple moving averages? And honestly, with decision point analysis, we really don't want the old data on the end to affect the newest data on the front. Because if you understand EMAs versus simple moving averages, an EMA puts more emphasis on the most recent market action, not on the end, which simple moving average just takes all of them, all of your entries, and everybody knows how to calculate an average. And that's how you get your simple moving average. And that's fine. But for our analysis and for our timing signals, we choose to use EMAs because we are a little bit more concerned about what's happening on the front end rather than what happened on the back end. So hopefully that makes some sense here. All right, so here we are looking at 5 and 20-day EMA crossovers. So right here, we had, well, it doesn't look like it actually occurred there. Let me go back over here. So right here, we had a negative 5 and 20-day EMA crossover. And where did it occur? It occurred above the 50. So it's a neutral, a short-term neutral signal. And again, neutral, meaning fully hedged or in cash, as far as whatever it is you're looking at. So again, I maybe don't want to hold through a neutral signal, or I may want to switch. And if I'm aggressive, I'll use it as a sell signal. But again, as I said earlier, I'm not aggressive when it comes to crossovers like that, short or intermediate term. A neutral to me is a neutral. I could stay in it if I want, but I'm not going to go out and short. That's the main thing. Anytime you have a positive crossover, always a buy signal for the short term. So here's another negative crossover, and that's a neutral because it occurred above the 50-day EMA. So over here, it didn't actually have that negative crossover, but the idea is that had that whipsawed up and then come back down, it would become a sell signal because it's below the 50-day EMA. So that's pretty much how these trend models work. And I'm going to go ahead and take you to some real life examples here. And I did, I think, a pretty good article Wednesday about bull and bear market rules and head and shoulders patterns. But all I really want to do at this point is I'm going to show you the one chart that's in here that explains that long-term trend model very well. All right, so I want the live version. And that's a trick, guys. If you see a chart you like in any blog article, click on it and you can get the live one. And if you want to save all those annotations, just annotate something of your own on there, and there you go. You'll be able to save it with all your annotations. So this is the long-term trend model. And as I said, I use it to determine whether we're in a bear market as far as what I'm looking at, in this case, gold, or I'm in a bull market. And the way you tell that is by those 50 and 200-day EMA crossovers. And so it's pretty clear here. You know, your 50 is below the 200. So you're in a bear market all the way through 2013 into 14 into 15 for gold. But then everything started to turn around. And granted, it's a long-term trend model. So yes, we missed all of this upside, but I look at long-term trend models to just give me what again, is it a bull market configuration or is it a bear market configuration? And one of the reasons my PMO scan, for those of you who have downloaded or looked at it, one of the things that I have as a requirement on the scan is that the stock have a long-term trend model buy signal, or, you know, I want to be in something that's already configured to do well. Because as far as bull and bear market rules go, and that's what the article is about, you know, I want to know what my signals really mean, what I should be expecting. So if I get a short-term trend model buy signal in a bear market, I'm probably less likely to trade using it, because I have to now expect bearish conclusions. I'm in a bear market. So you don't want to go in expecting, when you get that good chart pattern or however short-term, you know, trend model, buy signal, etc. You have to remember you're in a bear market, and you really should have expectations of these things not coming out the way you would like them to. Bullish patterns. The other thing, of course, as I talked about in the article, is, you know, if you're in that bear market configuration, bear market rules apply, right? Bear market rules meaning expect a negative, don't expect a positive. And I told everybody in the article that, well, obviously it fails when you switch from a bear market to a bull market. Obviously something positive is activating. You know, in this case, you've got a nice rounded bottom. So that, you know, would be it. The bull market configuration, again, now I'm seeing that 50 start to turn down. That's sort of my warning, right? What's going to be happening. And you can see right here, you know, when we got into that bear market configuration, price dipped very low. But as soon as we started getting that rally, you started to see that 50-day EMA, of course, turn up as soon as price got above it. And so while you may have, you know, you're in that bear market configuration and it took all the way to here to get that signal, you definitely had a clue when you saw that 50-day EMA make that nice turn to the upside. So let me look at just a few examples here. And I'm just going to pull up some of your 10 and 10 requests. I think this is an excellent example, and I'm going to annotate right here so we can look at what all of these models are saying at this point in time. So we'll look at what happened before. And I've got my arrows, so hopefully everybody can see. So right back here, we'll just start back here where we get a crossover. Over here, you can see whenever your fastest EMA is on top and your slowest is on the bottom, this is your perfect bull market configuration. I love to see the 5 above the 20, above the 50, above the 200. That's obviously as bullish as it can get for this particular stock. All right, so we came up here, and what was our first clue? There was some problems up here at the top. We had that 520-day EMA negative crossover. It was above the 50, though. So that means it was a neutral, a short-term neutral. So again, you got your warning. You can either get completely out, go to cash. If you're super aggressive, you could, of course, start shorting there. But again, I don't recommend that. So that was the first signal that occurred. All right. So we got that short term trend model neutral. Well, things started to continue to go bad. So that 5, started to really move down. But we also had the 20 now starting to fall. So we got a negative crossover, the 20 and 50 above the 200. Remember, we're in a bull market configuration. So it may be a negative signal, but it's, not to a position that I would probably want to short. Of course, you can look at this and say, well, why wouldn't you? You had done really well. Well, certainly, hindsight is 2020, isn't it? And I'm not that aggressive of a trader, even in the intermediate term. I haven't shorted a stock in years. I'll be perfectly honest, because we've just been in a nice bull market, and I just haven't found enough, choice stocks or whatever to short. But why would I even be looking for a shorting opportunity in a bull market? You really shouldn't be. So, all right. So there was our negative crossover for the 20 and 50. Well, things continued to go bad for IBM, didn't it not? So what was our next signal? Of course, the long-term trend model switched right here. And so that was telling us, okay, now we're in a bear market configuration. We need to start expecting bearish outcomes. All right. So we started to get this little rally, right? And it was pretty exciting, but it got to the 50 and it couldn't get above it. And we're in a bear market configuration. So I'm in this nice little trading zone. I shouldn't expect it to break out because the configuration is all wrong. I don't have the right signals going on. So I need to find a better candidate. Well, over here, right, we got that short-term trend model buy, but we're in a bear market configuration. So I would have probably tossed it aside, just not even considered this. Then we got the negative crossover on the short-term trend model. Obviously, you're going to get a lot more action there. A 5-day EMA moves a lot. So that, again, was warning that this consolidation zone, as soon as we lost the 5-day EMA, problem. But we're consolidating again, right? Well, now we've got that fully negative configuration. The 5 is below the 20, is below the 50, is below the 200. So terrible configuration. Should not expect a bullish breakout there. Just shouldn't. Ended up moving lower. And now look at the next signal that comes through. There's our 5 and 20-day EMA positive crossover. Nice. So now we know things are changing to the positive direction. I can maybe start looking at this as a short-term candidate for a buy. But at the same time, 50 is well below the 200. So this one wouldn't even show up in my scan because of that. And granted, I'd have missed out on, this big gap up and all of that. But again, I'm trying to minimize my risk. And typically, if you've got a stock that's in a bear market configuration, why start expecting you shouldn't expect that to happen. And as I said, well, eventually it happens when you do switch from that bull to a bear market. So you're going to get that pop eventually. But what happened before it? Well, here we got that 20 and 50-day positive crossover. So now we're on a short-term trend model buy and now an intermediate-term trend model buy. So that might pique my interest. And in fact, I do have a scan that doesn't consider the 50 and 200. It only considers the 5, 20, and 50, and when that gets into a positive configuration. So that got into a positive configuration here. Got the fake out on the 5-day EMA, but it came back up and continued to hold its buy signal. Of course, you got all this accumulation. Everything's looking good. We start falling. We're still in that bear market configuration. So again, I shouldn't be expecting these great outcomes. I should expect to get a pullback here, which we indeed did. The 5 crossed below the 20. That was that was more information on the short term. Yeah, you'd probably lost this, but you have to take a lot more into consideration besides just the trend models. I'm just giving you an idea of how, if you were only using them, what you would see. So we got the neutral signal over here, the short-term trend model neutral. We're still on that intermediate term buy signal, okay? And we finally got the 5,200-day positive crossover. So we're finally looking at IBM. now in a bull market configuration, and not only a bull market configuration, but a very positive one, because the 5 is above the 20, is above the 50, is above the 200. So, and now I'm looking at the PMO, and you can see it's backed off, but it's coming back up. It's not overbought. So things are looking a lot better for IBM. And I can tell that just by following those trend model signals. So that's pretty much how the trend models work. And let's see, I'm going to take us back over here. Oh, not to there. Let's go back to, there we go. All right. So again, timing techniques, and you guys always ask us these questions. You got to know your time frame, and if you know your time frame, you know which trend models to be paying the closest attention to, and that's all determinant on your risk levels. As I said, you can take a neutral signal and in your mind make it a shorting signal. It's all your call and how you determine what time frame you're in and what your risk levels are. And once you've figured out your time frame, now you need to scan and find the opportunities within that time frame. And as I said, my basic PMO scan, you can go in there and look at it. There's a link at the bottom of all Market Watchers Live recap articles. Clickable link. It'll take you right in to that. If you're a basic member, you probably won't be able to reach it because you don't get the scanning workbench. You only get the predefined scans. So a good reason to upgrade to extra, in my opinion. It's invaluable. Candle glance, that's a great way to look at your possibilities that come up with your scans. And again, best results, use the trends that match your goals. And there's no reason to get involved in something that's already in a bear market configuration. There's plenty of stocks out there in a bull market configuration, especially when we're in a big bull market like we are right now. All right. So let's go to creating a DP scoreboard. I want to just show you this quickly because I think it gives you an idea of how you put together the short-term trend model with the intermediate term with the long term. All right, so you've seen these. If you've read any of my DP articles, you certainly have seen a DP scoreboard. Well, notice the top row on the DP scoreboards. It's all about the trend model signals. And now, after listening to me, you know how each of these signals are developed. So in this case, let's go down here. In the case of the NASDAQ 100 right now, it's actually in a short-term trend model neutral signal. The 5 crossed below the 20, but the 5 and 20 were above the 50, so that became a neutral signal for the short term. The intermediate term, we're on a buy signal. That means the 20 crossed above the 50 on November 21st. The long-term trend model, back on May 24th of 2016, that's when we got our long-term trend model buy signal. So that's how you can put together what's going on that top row. PMO signal is pretty simple. Daily chart, where's the PMO? Crossovers. Intermediate is your weekly chart, and this is your monthly chart. So those are where you get the PMO signals. So as I said, just look at your daily chart to find your trend model signals because it's all based on 50, 20, or 5, 20, and 50-day EMA crossovers. And the PMO signals, like I said, that bottom row, daily chart, weekly chart, monthly chart. Short-term PMO, intermediate-term PMO, long-term PMO. And there we go. Let's move through. So as I showed you already how you can determine which signal is which. So that's pretty much the conclusion of my DecisionPoint trend model information. I hope it wasn't too fast and I hope it wasn't too confusing. But like I said, the main thing I just want you to know is how these signals are determined for these trend models. 5 and 20-day EMA crossovers in relation to where the 50 is. This 20, 50-day EMA crossovers in relation to the 200-day EMA. Long term, there's only buy and sell signals because it's based on 50 and 200-day EMA crossovers. But as I was saying in my article that I wrote on Wednesday, it's very important to know that long-term trend model signal because it really does set you up and help you to understand what kind of conclusions, what kind of expectations you should have when you're getting ready to invest in whatever it is. And if you want to take a chance that things are moving in the right direction, take a look at that 50-day EMA. Has it turned? Are we getting ready to have a positive 2050 crossover? There are a lot of pieces of information you can use, but this, in my opinion, if I'm looking for something to buy and not to short, I'm looking for a good buy, a good investment. I want to always make sure my 50 is above the 200. It's just simple math to me. Again, swimming with the trend, trying not to swim against it. You're going to be a lot more successful if you're floating down the river rather than trying to swim up it. So that would be my thoughts on that. And I can't even believe it, but we only have 5 minutes until the 10 and 10. I truly didn't think I would be able to talk this long about the trend models, but I have. So anyway, were there any questions, Tom, that right off the bat that maybe you saw that I could answer?
Yeah, there were. First of all, great presentation. I'm sure
Thank
everybody
you.
appreciated that. Getting some clarification on the DP models because you do use DP a lot, and going through a lot of your analysis. So I think it was really timely. Well, there are actually a few questions. One question is, how long do you stay in a stock after a neutral signal shows up?
Okay. All good information. So for me, let's see, let me go to something different. And let me see. I don't know if I still own Etsy, but it's not the best example because it's been in a bull market. It looks great. So I'll just go back to IBM. I think that's still a pretty good one because it's got a lot of different signals on it. All right. So I'm over here, right? I've got this really great configuration. I'm sitting in IBM. It's going great. We start to consolidate. Okay, that would probably give me a little bit of a concern right there. But also it would give me a big concern is this PMO sell signal. All right. I have to consider all of the things. I don't just consider the trend model when I'm making investment choices. Okay. The trend model, I think, is very helpful, mainly to help you get into the right stocks. I truly believe that. And that's mainly just configuration. I think the signals are very helpful. This would have given me a sense of worry right there. An overbought PMO sell signal. And that happened in the middle of a consolidation zone. Okay. So I'd already be a little bit, be watching this pretty closely. And I come here, okay, and now we're looking at a 5-day to 20-day EMA downside crossover. Okay, now I'm getting quite a bit more concerned. I'm looking at my PMO and notice we're getting distance. The margin is getting thicker between the PMO and its signal line. Again, that's bad news. This is you're getting warning all the way down. Okay, but maybe it's a buy and hold. And so you're not going to be quite as concerned about the short-term moves, the short-term PMO sell signals. And you're in a buy and hold long-term investment. So I got that. That's a big problem for me. And as we came down, now I got that 2050 negative crossover. Okay, granted, it's a neutral signal, but that would also give me pause. I now also have been warned when the PMO went below the zero line. So there's all of these warning flashes, and you have to put them all together, not just wait on trend model signals. So I'm in a buy and hold. Now I'm getting that 2050 negative crossover. So I have a negative configuration. Yes, I'm still in a bull market configuration. But again, I got that 2050 negative. The 50 is already turning over. We already saw the 20 turnover. Of course, we saw the 5 turnover. So that's the best answer I could give you as far as, using it with trading. I think that's a pretty good example. But if not, send me an email, marketwatchers@stockcharts.com.
All right, there was another question that I think is kind of similar, but different. Could you talk more about the decision to take action on the signals? How long do you wait for confirmation? So I guess one is, when things are starting to go against you and turns neutral, how long do you stay in the position? I guess this one is more of when you're thinking about getting in. You're taking action on your signal, but how long do you wait for that confirmation?
Right. Okay, I'm going to call up a different chart because there's nothing in here to tell me I would have bought. Even that 2050 day, I don't consider investments, like I said, until the 50 is above the 200. I just don't. It just seems simple to me. You already know it's in a nice long-term trend. So that's such a great foundation right there. But let me find a different one that's been in, let's see, how's gold here? Does that have a good setup here? Everything's kind of flat. Let's see. I'll pull one of these from, again, the 10 and 10, maybe that would be helpful. Okay. All right. Yeah. So I think this is a pretty decent one. Like I said, I'm not going to even, this stock is not even going to show up on my scan until the 50s above the 200. Okay. I don't like this chart either because I can't see the PMO. I need to get a better chart. Let's see. We'll try, let's try square. All right. I'm sorry. I just want to have a really good example for you. So, all right. All right. I think this is a pretty good one. So I would, again, this wouldn't even show up on my scan until the 50 was above the 200. So I'm just going to look at what's going on over here. So it probably would have shown up on the scan when I got that 3 days moving upward, the PMO buy signal. Again, it just depends on the scan I'm doing. I would be looking at this and yeah, it was in a bear market, but now I'm getting really nice vibes here, right? I've got a positive, bullish confirmation here with price bottoms and PMO bottoms. So I'm getting in, right? So I'll say that I get in right about here because I've also noticed that the 5 is above the 20, is above the 50. So it's already got a nice little configuration. I've got that positive divergence looking good. So I would be remaining in, right? I've still got all of these working in my favor, still in a bull market. Yes, here's the PMO. It's crossed over. I have explained on the program, and I think in a lot of my blogs, once I'm in, I'm not really that concerned about the PMO, and mainly because it's a shorter term signal. It's a momentum signal. You can get a lot of crossovers, and most of my investments are more intermediate term. So I'm not going to pay as much attention to the PMO, especially when I'm looking at such a nice configuration. So there's a short-term trend model, neutral signal. It might raise my eyebrow, but I'm going to hang in there. We're still above the 50. 50 is above the 200. It still looks pretty good. And sure enough, we got the move up above the buy signal again in the short term. PMO's looking great. So I'm going through here. Well, when the heck would I consider a sell? Probably not until I got down here when I got that negative 20, 50-day EMA crossover. And I might even have looked at this and gotten out even a little bit sooner because I had that short-term trend model. But even before that, I had that PMO sell signal came in right here. So I'm holding these. When I'm holding them, I'm looking at these charts fairly regularly. Okay, so I got that. Remember, we got the sell signal back here, but we never got a 20, 50-day negative crossover, but we did over here. So that would probably be my cue. At that point, if I hadn't gotten out already based on the turnover of the 20 and the turnover of the 50, I would by now have gotten out. So I would have bought right back in here. I'd gotten the buy signal. So I would have done all right. It wouldn't have been great. I might not have gotten out at the top, but that's when my upside targets come into play. I mean, there's more that comes into play, but that should hopefully give you a little bit of an idea of how I might use the trend model as far as my trading in the intermediate term.
All right, very good. There were some other questions in the chat room. Maybe while I'm doing the 10 and 10, maybe you can go back through and take a look at them and either respond there, or maybe if you have one or two that are really good, we can come back and discuss those in a bit, maybe after.
Yeah.
Before we end the show today. Maybe that
All
would
right.
work.
That sounds good.
So I'll give you a little bit of a break here. I know you've been pretty busy here through most of the show, but we'll go ahead and switch it over to the 10 and 10. I'll go ahead and grab the screen and you can go ahead and fire away.
All right. So the first one was TRN.
Okay, TRN. So we got Trinity Industries. I like this one. After going back down and testing gap support in the 50-day moving average, this thing's been back on a tear again. So here was the gap support area. And you can see we came back down. We actually closed a little bit below. Look at that long tail below the 50-day moving average, heavy volume. That was a breakdown intraday. Why would it come back up and close above the 50? Not too many technical traders would be buying it on this huge move down, but we did come back up, leave that tail to the downside, hold the 50-day moving average, and then we had an engulfing candle the next day, at least engulfing the prior day's body, which I think is good. And the volume there was decent, not as heavy as the panic move to the downside, but pretty decent volume. And from there, it's been straight up. MACD looks great. I don't really see anything wrong with this stock at all. In fact, volume's been really nice as it's made this breakout over the prior high. I'd say for me, I would be watching the rising 20-day moving average. I mean, I think the momentum is strong. So any kind of a pullback to that 20-day moving average would be probably an entry point for me.
Okay. I'm just going to be since I'm in the chat room here making notes. I'm not looking at these beforehand, so I'm just going to throw out the symbols. But CVS was getting a lot of interest at the beginning of the show.
Yeah, CVS, is gapped down. It's a pretty big volume. It's trying to come back up. I think there's a lot of indecision going on with this stock and this movement back and forth across moving averages. I know that there was one question in the chat room talking about Martin Pring and how he doesn't really look at moving averages during periods of consolidation or just sideways action. I would say I completely agree with that 100%. And this is a perfect example when a stock just can't seem to make up its mind. It moves above the moving averages, comes back down beneath them, and now it's right back up above them. In this situation, I wouldn't be concerned at all with what's going on in terms of the moving averages. I would focus exclusively on price support and resistance. And for me, the recent low is going to be your major price support, and probably just the recent high up here at about 76.5. We tried to take out this high, and I think I remember talking about CVS. And, when we were trading up here with this tail, saying that we needed to close above that level. And instead, we kind of closed right on it. And then the selling kicked back in again. So I think this I don't see a trade for me personally. I think it's between this trading range of 76.5 to the upside, 67 to the downside, sitting around 73. I would sit on my hands and wait. You got another one, Erin? I'm not hearing anything. I don't know if you muted yourself.
UCTT. I did mute myself.
Okay, UCTT. All right, Ultra Clean Holdings. Well, you gotta. This is when you got to be really careful, I think, with a stock. I know we're in a bull market, and I try to make a lot of bullish excuses for stocks. But when you got a stock that is in a really nice uptrend, kind of like this one was in for a while, and then you see a breakdown in price support like this, and on this kind of volume, you have to take notice. I mean, to me, that completely changes the outlook for this stock. This is not a light volume pullback. It did not hold price support. I have seen heavy volume selling before, and I'm still bullish the stock because you don't lose price support. In this case, I think it's pretty clear after a double top breakout on increasing volume here, we went back, we held the support, kept moving higher, everything looked fine. And then something happened, probably an earnings report, that threw a curveball on Wall Street. And Wall Street doesn't like curveballs; they like fastballs. And this moved down. The failure at the dropping 20-day moving average and continuing movement to the downside. We've gotten a temporary relief off of this hammer that printed down about $20, $20.50. But I still see this continuing to trend lower. If we could get back through $23 with increasing volume, I'd be willing to maybe reevaluate, but until then, I would be passing on UCTT.
Okay, let's see. The next one I have for you is SLV. We haven't looked at that in a while.
All right, this is iShares, the Silver Trust. We have been completely falling apart. We're in a downtrend. I'm not a huge, player of the Silver Trust or gold or any of that. It's just not my style, especially when we're in a bull market. But just looking at the chart itself, I think clearly heavy volume, reversal, all made down here at about 1440 to 1450. So for me, it's just all about price support and whether or not this holds to the downside. So as you get closer, I think it does become a better reward to risk trade, but it's not like we're in an uptrend pulling back and testing a recent breakout. This is in a downtrend, and a lot of times a downtrend is a series. You do get a series of tests of support, but eventually they give way, so you stay in that downtrend. So I wouldn't touch this one until it at least got down to price support, and if that failed to hold, I would be out of this position.
All right. Let's see. The next one I have for you is, let's see, IMGN. Yeah, that one gets a lot of immunogen. It gets a lot of play.
Yeah, the biotechs are doing pretty well today, or some of them anyway. IMGN is just kind of flat. It is actually up, well, it's up to a couple percent. Doesn't look like it here on the chart, but that is a pretty nice day, 2.5% today. It looks to me like it's trying to maybe, well, maybe not quite. 650 is a pretty key area, just looking quickly at the chart, and I'll just show the auto support resistance line there. You can see the support held here with a tail below it. We move back up. Then volume is heavy over here as we break through 650. Notice we had a false breakout above 650, couldn't stick, went back down again. We've been consolidating. Just had another failed test at 650 maybe a week or so ago, and now we're rising, but we still got the 650 level to contend with, and I'm not sure if the trend line will intercept as well. But I mean, if we just kind of take this down, well, I mean, you can draw the trend line any way you want. From the highs, you can see that the trend line, if I just connect the highs, would be around 7. If I connect the candle bodies, maybe it's down closer to about 670 or so. But this area clearly is going to be some key resistance to try to get through. So I like the biotechs. I think this one is okay. I think there are others out there that look better, though.
All right. Next one is going to be CTRL.
All right, CTRL. And this is Control 4 Corp. Yeah, I think this is an interesting looking chart. I'm okay with it at this point. I'd like to see it get back through that 20-day moving average to feel a little bit better. We did go a little below price support, it looks like. Not really, not much though, if any. Nice little reversal here, right at about price support. You can see that hammer printed on both the 20-day moving average and price support. And now we're back really just testing these recent lows. You got a nice trend line in play, which I could draw in here as well. I'm bullish the stock, and I'd be looking for a move back to the upside, probably sooner rather than later. Let's see. That's pretty close. Yeah, and you can see, so the trend line and price support both come in between 30 and 31. Stock sitting at 30.47. RSI, which all year has been 40 or above, is currently at 42. So again, when we're talking reward to risk, to me, this is a great reward to risk entry on CTRL. If it fails, I get out pretty quick. But to the upside, if this uptrend returns, you're looking at 30 and a half up to maybe 35, 36 as your target. So I think this one looks pretty interesting.
All right. Let's see. Number 7, DGX.
All right, DGX, which is Quest Diagnostics. There's a nice uptrend, but that is a shooting star. And it's not just a shooting star, it's a shooting star at major gap resistance. So that was a pretty good clue that run was over. You can see here, we had gap down. Look at the volume on the gap down, the continued selling. We did have nice volume coming back up, but when we got to the very first area, and this is why when you have these wide gaps, look at this move through the gap resistance zone. And 2 days later, 3 days later, we were at the top of the zone. That's why it's always important to me to get through and to have volume on the way up, which we saw here. But that reversing candle at gap resistance, I would have expected a move down. Now you've got support and the 20-day moving average at about $96. So I think it's in a range between 96 and 101. If you're a fan, I'm not sure what the news was here, if this is earnings related or what. But if I was looking to go long, I think the best reward to risk entry is about 96, 95, 75, something like that, with a target back up here to test the top, maybe around 101, and I'd have a very tight stop to the downside.
All right. Let's see. Next one I have for you is EXAS.
Exact Sciences.
Mm-hmm.
Let's see. Another one that I think looks really good off this 50-day test, and it tested basically a gap support zone. So let me pull this up. See the top of gaps. Actually, here was the top of gap support right here, but we went a little bit below. So to me, that's the reaction low. You can see basically we had prior high here. So this is kind of the support zone that I would be looking for. And I think if we connected some trend lines, we'd probably come right up in this area as well. But 50 to 52, maybe 51, 52 in that area, I think is best entry. And to the upside. And by the way, look at this shooting star off of the uptrend. Once again, marking a top. But right there would be my target. Anything up to around the 60 level, I would probably be a seller. Now, it isn't an uptrend, and as Arthur Hill likes to point out, resistance typically doesn't hold in an uptrend because you continually are printing higher highs. But you can see here, once we tried to get back up here, we failed, went back down. I don't like to hold my gains until they become flat again. So when I see a stock get back up close to resistance, I like to just take the money and run. If someone else wants to hold it for the breakout, that's fine, but that's just not my style. This is a pretty good reward to risk trade, though, from where the stock's currently trading. And I think it even gets better if it drops another, say, $2 or so back down closer to 52.
All right. Next one I have is TDOC, Teladoc.
All right, TDOC. Well, pretty clear to see where the resistance is on the stock. We've had a couple of a few attempts trying to get through that $37 area. So I think with these tops here, look at the volume coming in, all this buying, and it stops at 37. Once again, volume coming in, stops at 37. And again, volume coming in, and it stops at 37. So that is a sell point until the market proves otherwise, until we can get this stock to go through 37 or 37 and 37.10, whatever this number is. I think that is the key resistance. So I would be a seller there until it can get through. It may require a gap. It may need some news and maybe gap above to get through, as I would think there would be a lot of sellers lined up based on the way this chart has been moving. To the downside, I'm going to say maybe this reaction low along with the breakout there. I think this is the key support area. So we're in a range right now where it's sitting in the middle. I don't think there's really that much of a trade. I think if it were to drop, especially on lighter volume, and move toward the lower end of the range, I think that would become a buy, or on a breakout, because this sideways consolidation I think is bullish, and a breakout would likely result in an extended move to the upside.
All right. I gave you EXAS, didn't I?
Yes.
All right. So that leaves number 10. Let's do NVIDIA, NVDA.
All right, last one, NVIDIA. And all right, first thing I'm going to do before I even look at the daily, I'm going to go to the weekly. Because if you look at the weekly, notice NVIDIA loves tests of its rising 20-week moving average. That has been the case for the past 2 years plus. We haven't seen very many weekly closes below that 20-week moving average. This week's low was $180, and the 20-week is at 185, and we're right at 192 now. So we actually went below the rising 20-week moving average. We held, and we're back above it with a higher MACD on the most recent high. So keep in mind, from a longer-term perspective, I'm going to be bullish based on this chart. So with that, we look at the daily chart, because you look at this and you say, wow, heavier volume, stocks breaking down, 20s crossing below the 50. This is horrible. But if you step back out and look at that weekly chart, it paints a completely different picture. So I'm going to remain bullish on NVIDIA. I think that this is an opportunity on this pullback. I think maybe this reaction low down here around 170 is worth watching. The prior high should have been support on the way back. We actually went a little bit below, gap down, and came back up above. I think the fact that it's tested its rising 20-week moving average and it's tested the top of this support zone, I'm guessing that NVIDIA's weakness has ended and that the stock is going to move back higher. I'd be looking at my target of around 218. So the question is just setting up a trade where you're comfortable with your potential target or potential rise to the target versus your potential risk. What are you going to give it to the downside? Is it going to be where it opened? If that's the case, it's going to be probably close to around 182. If that's your stop, a close below 182 or an intraday move below 180, you got to make sure that you have enough reward to the upside to make it worthwhile for a trade. So NVIDIA, I love the stock. After this bounce, though, I think it does make it a little bit more difficult to set up that reward to risk properly. So if we could get another pullback, the next week typically is not a good week for the NASDAQ. Maybe that'll set us back up with a little bit better trade on NVIDIA. but I like the stock based on the long-term chart, even though this daily chart may not look particularly appealing with these heavier volume moves below the moving averages.
All right. And that's 10 in 10.
That is 10. Well, we've got started late, but it might have been 10 and 15. But
Yeah, I think we did all right.
yeah, it's okay. Okay. I know we got another market update and you've got
Yeah.
sentiment, so I'm going to let you just take it away.
Yes, and I did have some questions that I'll answer on air. So first of all, I'm going to take us to Candle Glance, and I want you to see how you get to it. Just in your control center over here, Candle Glance. And what's been happening? Not a whole lot. Dow Jones is still trending upward, but in the last hour, it's not looking so good. We can see it's pulling back slightly, but we're still in a nice rising trend when you look at the Dow. S&P 500 looked like it was just going to consolidate sideways, but we did get a breakout, and it's now looking at close to intraday highs. We're looking at the Nasdaq still consolidating sideways. Got that really nice move. Pulled back. Last time we looked at this, it had pulled back somewhat, and that was a bit of a concern, but it looks like it's coming back up. So that ultimately we're pretty much consolidating where we were when we started. Russell 2000 is moving in a nice rising trend up at this point. We can see treasury yields are unchanged, not mostly unchanged, but unchanged right now at 23.76. UUP had a pretty nice morning, but since about 11, it's been pulling back. Still looking pretty good. It's reading at 24.44 for UUP. Kind of a volatile day for commodities. Looking at USO, we can see this V bottom, and now it's followed by another. Now we're looking at a V top. Both of these just pretty, looking at some volatility here, a lot of choppiness. But ultimately, USO is up at 1146. Gold mostly unchanged, but lower at GLD at 118.39. And volatility index continues to move lower since we started on air, and it currently is reading at 960. And with that, I'm going to end early our last market update because I do have a lot to cover and I want to make sure I can get it in. So let's see here. I'm going to give us a new share over here. So actually, to answer some of the questions, I'm going to pull up somebody's 10 and 10 request. So a couple of bonus ones happened in there. So I'm going to do ACLS, Axcelis Technologies, and looking at my questions, because I copied a bunch of them in here. So one of the questions was, I believe it was Martin Pring who stated that moving averages are only a value during markets that are trending and are limited, don't have a lot of value during periods of consolidation. Do you agree? And if so, how does this affect your model? And if not, why not? Well, first of all, I don't think there's ever a chance that I will disagree with something that Martin Pring says. Just laying that out there right away. He was one of my big teachers as far as learning technical analysis. So yes, I mean, I'm looking at this, right? How useful are the moving averages right here now that it's trending and in a bull market? Not particularly helpful. So, personally, and as I think I've explained when I went through these models, they're information, they're confirmation, they're warning signs if there wasn't something else you were already seeing on the chart to be a warning sign. So, for example, this would have been a perfect place to come in. The PMO would have been rising. We'd have that buy signal in oversold territory. So that would have brought it to my attention. The 50 is already above the 200, and then I'm getting confirmation. So I probably would have bought it in here. I'm getting the confirmation right here where the 5 crosses above the 20, right at the end of August, right after this signal. So that would have probably been my aha moment, as you might say. Hey, this is looking pretty good. We have a really good chance at a breakout here. So I would have it on my watch list. You could also see right here, if you draw horizontal across and a rising bottoms trend line here, just kind of slightly rising, that would be considered an ascending triangle. So that would also be excellent information for me. As soon as we got this breakout here, I would have certainly been very interested. Okay, well, now here's confirmation for the intermediate term. 20 crossed above the 50. Now I have this perfect configuration. And yeah, we're trending. So obviously you're not getting a whole lot of information here. But right here would have been my first warning, an overbought PMO sell signal. But it wouldn't have really worried me that much, only because, yeah, the trends are still looking pretty good. And as we know, when you're in a bull market, you shouldn't let overbought conditions worry you too much, because you can sit in overbought territory for quite a while. Prices can continue to rise and rise and rise. We've seen that in plenty of stocks and even in the indexes. So that would have been a warning. This would have been an even larger warning when I would have this margin build like that with the PMO falling. And, then I'd get that 520-day EMA crossover, and I'd be just that would probably be it for me. I'd also, more than likely, my stop would have been here at about 30. I mean, it would probably have been very low, but if I'd gotten in here like I would have planned to at this point, that's plenty of profit if that stop ended up getting triggered. But I think I would have already been out before it hit 30 just because of that signal. So yes, technically in trending markets, you're not going to get a lot out of that, because you're not going to end up with a lot of crossovers. But when you do finally get the crossovers, I think that is a really good attention flag. So especially if you're already holding an investment, these are the things you need to be watching for that should give you a little bit of concern. And then you can continue to watch that price movement. You can continue to watch and see where these EMAs are going. But, as soon as you had that breakdown below the 20, and then you had it touch down below the 50, I mean, those are really good warning signs, I would say, to let you know. Let's see. Using moving averages are lagging. Don't you use other indicators? Yes, I think I explained that. Why do you use EMAs instead of simple moving averages? As I explained at the beginning of my presentation, but you were probably not here. A simple moving average, you're taking all of your data points, and you know how to calculate a simple moving average, right? So each piece of data each day has the same weight. With an exponential moving average, you put more weight on the values at the end, closest to you, the more current values, because of the way it's calculated. And the values on the very back end have a little less, it doesn't affect the average quite as much. So for example, if you had this horrible correction at the beginning of your data points, that's going to really skew what you're going to get at the end of your moving averages. And that's why you can get those big differences. But I prefer the DecisionPoint trend models. We prefer to have the most current data be the driver of what our signals are. And let's see, what does it mean when the PMO goes below zero? When I use my PMO, let's see, I have that in here, I think. No, it's not in here. Where is it? The PMO, yes, analysis charts. This, I think, gives you your best idea of why above and below zero are considered good, bad. So I'm going to just scroll down here. This is the S&P 500. So the first thing in the short term, you're watching the PMO, whether it's rising or not. That's your short term, okay? Is it rising? Is it falling? So that's your short-term information. Has it had a crossover, a buy signal or a sell signal? That's the other thing you're watching. That's an intermediate term signal. But a longer term signal is whether the PMO is above or below zero. So it's more of a long term, but it's information that you should have. And I'm going to turn it back over to this chart. So the PMO went below zero here. So that should be something that grabs your attention, because that's a long-term bearish signal, so to speak. It's not a timing signal, but it gives you warning that there could be some serious issues here. But it's also, let me add that to the watch list, because when it turns around, that might be a good time to get in. So let's see. So that's what it means when the PMO is below zero. And yes, somebody said, well, if you had followed the trend model, you'd have bought IBM at 163 and sold it at 164. Yeah, that obviously, if you just follow trend, let's face it, I think everybody will admit to this. Moving average crossovers, moving averages in general, are lagging. They just simply are based on what they are. So for me, I think it really just they're really great confirmation tools for what's going on. And I think they're good to give you some warning when you start seeing. And Tom always is looking at where price is in comparison to the 20-day EMA. So those were the questions that I had answered. If I didn't get to your question, you can, like I said, send the question to marketwatchers@stockcharts.com, and I will do my very best to get back to you. But also consider rewatching the presentation if you did come in late, because more than likely I probably answered your question at the beginning. So with that, and I'm going to catch my breath right now, I wanted to just show you a few of our sentiment charts because it's Sentiment Friday when I show you those sentiment charts. Not overly interesting today, but I did find interesting, though, is on the put-call ratio chart. This is the S&P 100. 10-day moving average of the put-call ratio is what we're looking at here for CBOE, equity, and OEX. So typically what I'm looking for are bottoms on these and actually highs on the OEX, because the OEX put calls, a lot of times those are used as a hedging opportunity, so they don't follow quite the same. I've almost been tempted to take it off because it just doesn't always track as well. But the main thing I wanted to show you is, remember, I thought we were getting a bottom on these. And when you get the bottom on the put call ratio, it's usually a decent sign that, you might have some issues coming up here, or you could be looking at this upcoming rally. So I've marked here where we've gotten bottoms on these put call ratios. And, the lower these ratios are, the more bullish people are. So that's why I consider it kind of an oversold reading to consider. But in any case, I think it's really interesting that we are seeing bottoms right now on these two indicators. So we'll want to be watching to see if we're going to get, a decline out of these, because a lot of the times you can see we get some declines off of these. Let's see, what was the other? AAII, American Association of Individual Investors. I didn't think this chart was overly interesting. I thought it was kind of interesting looking in the thumbnail that we have a move. We've expanded bulls, but we've also expanded bears. So basically, we've lost some of those neutral. People are jumping on the bandwagon one way or the other, and it's pretty much split. A bull-bear ratio of 1 means you're at exactly 50-50. So we're getting closer back to that 50-50 range. So, sentiment is only useful when you hit extremes. And so that's why I have that black arrow there, because that was an extreme. And usually you get those extremes here. You end up, it's bearish extremes. So you're going to end up with, sentiment is contrarian, correct? So if you have a lot of bears, that's when you should expect a market turn. So that's what that particular reading did for us. And, you can see it came in right after that consolidation. So I thought that was interesting. And let's see, name, National Association of Active Investment Managers. And, I thought it was interesting that last Friday, and, we weren't, it was, I'm pretty sure I showed this chart, but in any case, we had this big jump in exposure. And I thought that was interesting. And honestly, that's rather bearish for the market. If they're getting more exposed, if they're feeling really bullish, a lot of times you're going to find extremes there. And, things are going to move the opposite direction a lot of times. So we're seeing it pull back, though, to levels not quite as low as we've seen. But we'll be watching to see how bearish the active money managers get. But right now, it's sort of in that neutral zone, just like the AAII. RIDEX analysis, this one was a little confusing for me today. And I was telling Tom, I said, I just don't get it. So you've got, okay, so you've got money going into money markets. That means people are maybe want to sit on the sidelines. And where is it coming out of? It's coming out of the bull sector. Okay. So we've got an increase in money market. That means, well, I'm going to pull out of the market right now. I'm feeling a little nervous and I'm going to throw it into cash. but they're not bearish enough to be throwing it into the bear funds, are they? Because that's moving mostly sideways. So, like I said, I think we've got sort of a more neutral situation. We've got, oh, I'm a bull, and we've got, oh, well, I'm a bear, but they're pretty even. And I think that's what this shows when you've got people moving into cash. And remember, when I do trend model neutral signals, that means moving into cash or getting fully hedged. And that's what I see here. And with that, Tom, I am done talking. I'm going to let you take it away, and I'll try and determine what my feelings are for the next week, because we do have to take our little poll.
Okay, very very well done. You get the rest of the weekend off. How's that?
Oh, thank you.
All right, I got a little bit of humor. I'm going to humor myself anyway. Just I saw New York Times, a comment or out of the New York Times, and it was concerning Alexion Pharmaceuticals, ALXN.
Mm-hmm.
So let me go ahead and grab the screen. First of all, here's the chart. So you can see Alexion been underperforming. Today, however, it's up 8%. It's up $8 to $115. And New York Times reported that Elliott Management has urged the company to do more to lift its stock price. I wish it was that easy.
Right. I was going to say, well, what do you do?
I've got like 6 or 7 companies. I want to go on record right now, and I want to urge all of those companies to do more to lift their stock price. I don't know what that meant. I guess maybe they're supposed to explore different alternatives,
Mm-hmm.
maybe make more sales, increase their margins. I don't know. And maybe I'm just crazy. Maybe my sense of humor is just not right. But I read that and I'm like, isn't that what every company is supposed to be doing? But anyway, they are urging. They're not just telling or asking. They're urging the company to do more to lift its stock price. I thought that was kind of funny, but it's working.
Apparently, whatever it is they did, right?
Whatever they did is working. So I am on record urging all the companies I own to lift their stock price right now. Next week would be preferable. I'm short term. I don't have a whole lot of patience. So if they could lift it next week, that would be good. All right. Well, we got to talk about next week. We're running out of time here, but we do have our predictions on the line as we head into the next week. It's been a crazy roller coaster, and we're starting to see a little bit more strength. If we go back to the home page here into our dashboard, you can see very good day. Dow's up 92, NASDAQ's up 40, S&P's up 13 and change, Russell's up 6. Really, green everywhere around, and everything goes with green. That's one of my favorite.
Oh, I know, right?
I love green, but I tend to be much more bullish on average than most. So anyhow, what do you think? Do you have any comment?
Well, I know it's currently up. My bullish call on Friday looks pretty decent, but we could end up pulling back enough that your neutral call will be the best. But, going into next week, I honestly, I probably would talk to you and say, well, what does seasonality say? But that's not fair, because that's what you use to determine yours. So, I've got PMOs rising still on weekly charts, on the short-term charts. I have to say I'm going to remain bullish right now. And I think we even got a little bit of a pullback this week, but, survived it. And I think next week should be good.
Okay. So you're going bullish?
I am going bullish for next week.
Wow. I tell you, it is hard to fight with a bull market.
Yeah.
It's kind of a losing battle for the most part. Yeah, next week, I mean, and you're certainly free to change based on my seasonal, the seasonal patterns. The market does tend to be pretty weak next week, which it goes against all the other calendar months of the year. The way most calendar months line up is that from about the 26th, 27th of one month to about the 6th of the next month tends to be bullish. Then we get into a period of profit taking 7th to the 10th. Then the 11th to the 18th is very bullish. And then the 19th to about the 25th, 26th is pretty bearish. That's, I would say, the most bearish period of the year or of the month. But when you look at December, it's really weird the way December has performed historically. And I go back, 1950 on the S&P 500. So I'm just not talking about the last couple of years. I'm talking about several decades. And December, for whatever reason, tends to be weak from about the 5th or 6th to about the 15th, but really weak from the 11th to the 15th. And that tends to be a bullish period for just about every other month. So that's one thing that's odd. The second thing that's odd is that December 15th to the 31st, the second half of the month, is much more bullish than the first half of the month. And that also is a little strange compared to the other months. And then when you get into the final, when I said that the most months we see this bearishness from the 18th to the 25th or 26th, that is a very strong period. The Santa Claus rally begins, and normally the market does extremely well. So December is really not like any other month, and I guess it's the holidays. People, maybe in a festive mood. I'm not quite sure.
Somebody said stock buybacks, maybe. I don't.
Yeah, maybe we're certainly seeing a lot of that right now for sure. But I'm going on a long time about a very easy answer. So I'm just going to say neutral. I'm just going to bail. I'm going to bail again and say neutral. I'm very bullish the stock market, but just with the seasonal patterns and with the rotation that seems to be taking place right now, I'm just going to say neutral.
All right. I think that wraps it up.
That will wrap it up. So I want to thank everybody for coming in. Always appreciate your support and everything you do to make Market Watchers Live what it is. Please, as you exit, complete the survey if you don't mind. We love to get feedback. Lower right part of your screen, you'll see how do we do. Very, very brief survey. Put in there whatever you'd like. But, Erin spent a lot of time going through the DP trend model, so I'm sure she'd like to hear what you thought of that. But just to give us any suggestions you have for improving the show. As a reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Friday afternoon, a great weekend, and happy trading, everybody.